Welcome back. Today we're tackling a question that sounds ripped from a political thriller. Can a sitting president oust the Federal Reserve Chair to force lower rates? We've seen the headlines, we've seen the conflict, quite entertaining. Trump, Jerome, Powell. Now, what we need to know is, how does that even affect our portfolios and our plan? Stay with me as we unpack how the Fed's independence works, why it exists, and what markets do when politics lean on monetary policy. If you want clear, no jargon breakdowns and just raw truth on financial topics, subscribe to our channel for more upcoming videos just like this. Hi, I'm Andrew Nida with Asset Management Group. Now let's begin with how the Fed became independent. The Federal Reserve was created in 1913 to stabilize banking and credit. To insulate from short-term politics, Congress designed staggered long-term terms for the Board of Governors and set up the Federal Open Market Committee, the FOMC, probably something you've heard in the news. The FOMC has 12 voting members, 7 governors, the New York Fed president, plus 4 of the other 11 regional bank presidents on rotation. No single person, not even one, can dictate policy, not even the chair. The chair member serves a 4-year term, reports to Congress, and does not serve at the pleasure of the president, no matter how much the president wants that to happen. Now, a pivotal moment came with the 1951 Treasury Fed Accord. That agreement freed the Fed from its wartime duty to support Treasury borrowing and let it prioritize economic stability over politics. History since then, including the inflation of 1970, shows the cost when independence erodes. Bottom line, the structure is built to support policy. It's a committed decision, not a political decision. Now let's fast forward to today. The US dollar's global reserve status is being questioned. US government debt is increasing at a formerly unimaginable rate. And interest rate policy is more directly controlled by the central bank rather than the market. Since the shift to an abundant reserve model in 2008, against this backdrop, the Fed is facing political pressure to lower rates at a magnitude we haven't seen in decades. It's literally a headline all the time. The question is, would forcing the Fed chair out serve to help the dollar or the U.S. fiscal position in any meaningful way? So, can a president fire or move the Fed chair? Legally, governors can be removed only for cause. That means misconduct or neglect, not, I just simply don't like your rate decision, which has been voiced pretty loud and clear. Now, presidents Truman, Nixon, and more recently Trump have pressured the Fed, but they've stopped short of firing the chair. And in my opinion, I believe that's because markets would read that as an attack on the independence of monetary policy, which is something you and I both definitely do not want to see happen. In fact, we witnessed a soft version of this in the early 1970s. President Nixon pushed Chair Arthur Burns toward easier money ahead of the 1972 election. A bit biased, I would say. And that backdrop helped set up stagflation, high inflation, weak growth. Now, could a president try anyway? I mean, possibly, but it would likely end up in court and the market reactions could be the bigger deterrent at that point. If investors believe and think that future chairs are political appointees, then they should remain that way and hold their independence without a bias. Now, what if a president undermines the independence, vocally states that he wants an individual removed? Now, historically speaking, presidents have pressured Fed chairs on policy decisions. That's nothing new. But they've never crossed the legal line into removal, respecting the Fed's autonomy. Now, Trump's current push, I mean, it's aggressive. And does it risk eroding the proceeding, potentially destabilizing investors' confidence? Possibly. For investors, the implications really could be profound if Trump's pressure actually undermines the Fed's independence. It could potentially cause market volatility, A politicized Fed might prioritize short-term growth over inflation control, lowering short-term rates, but spiking long-term Treasury yields, disrupting bond and equity portfolios. With a 10-year Treasury yield already at around 4.4% in July of 2025, unchecked inflation fears could push it higher, which long-term yields are more sensitive to market dynamics, facing even greater upward pressure. That being said, our outlook on the importance of diversified portfolio, it remains the same, as we believe that volatility from more isolated Fed drama, if you will, should be short-lived relative to true fundamental market-based investments and the other dynamics at play. The odds of any legitimate threat to the Fed's independence are likely overblown. Open pressure or threats over rate decisions definitely can shake confidence in independence policymaking, but it shouldn't shake the way that you invest your money. There are guardrails for a reason. The FOMC, they vote. The chair's term is fixed, and removal is for cause only. A complete breakdown is unlikely, but the headline noise, it may be uncomfortable, but alone can jolt portfolios and business sentiment short term. That's it. Now, why independence matters to you and me? The Federal Reserve's century-long role as an independent steward of monetary policy, anchored by its dual mandate, remains critical to economic stability. Trump's challenge to Powell, it tests the foundation. But legal protections and historical norms suggest the Feds will be just fine and they're going to hold firm. Financial advisors must stay vigilant, educating clients on the Fed's importance and the bracing for market ripples if political pressures persist, especially amid the current sensationalized headline cycle, the upcoming decision of a new Fed chair. The Fed's independence is not just a policy cornerstone. It's a shield for market volatility. Now, you have to keep your head right as an investor. You have to have a plan. You have to be locked in. You have to stay consistent. You need to stress test your rate exposure. Know what a 1 or 2 percentage point move in long-term rates does to your bond duration and mortgage refinance, whatever your plan may be. If you have diversified fixed income, blended with short-term intermediate duration, consider quality credit over reach for yield bets when policy looks politicized. Talking about equity balance, favor quality balance sheets, and consistent cash flow over highly levered stories or companies that are dependent on cheap money and overnight lending. Maintain a cash buffer. Get a good rate on your cash so you're not forced to sell just on headline volatility. You have to stay process driven. Rebalance on schedule. Don't let politics headlines dictate your allocations or your investment strategy. Look, at the end of the day, Fed independence isn't an ivory tower debate. It's about the price you pay, the rate that you borrow, and the confidence that you plan with. If you think elected leaders should have more say over interest rates, tell me why. I'm so interested in your opinion. If you believe that the Fed should stay isolated or insulated, then tell me what convinced you. Drop your take in the comments here. If this helped and this video was informative, share it with someone watching mortgage rates or trying to figure out if they should do a refi or trying to build their plan. And for you, if you're looking for no jargon, clear breakdowns, and just raw truth on honest financial topics like this, then make sure you take time to subscribe. And make sure you take time to watch our next video.